So the Fed minutes are coming out right now. We've got Edward Lawrence going through them. In the meantime, the wild ride continues. By the way, folks, it's not only stocks, right? Buying yields all over the place. Oil continues to plunge. Meanwhile, signs of more rotation in the stock market itself, as some investors are now betting that the Fed's new stance is akin to coming in like a lion to tame inflation, but exiting like a lamb really quickly. So as they shift gears, maybe you should be shifting gears. It's the perfect time to comb through the history books, get some clues and ideas on how you want to go about this. So joining me right out the gate, I've got Kaltbaum Capital Management, Gary Kaltbaum, along with Market Gauge Managing Director, Michelle Snyder. I want to begin with the notion of buying for a trade and maybe buying for a trade that becomes a home run. Listen, we know the stock market at some point is going to turn higher, probably before the recession ends. And within that move, some stocks are going to turn higher long before your major indices do. So let's go back to the tech bubble, to the tech crash. The NASDAQ bottomed in October 2008. Lots of stocks had already hit their low point. They had begun to scream a lot higher. So I'll give you an example. Amazon hit its low long before. By the time the NASDAQ bottomed out, it was already up more than 100%. Intuit, same story, up 100% by the time the NASDAQ hit a bottom, and eBay up 89%. And if you want to go out further, let's just say you bought and held, you'd only be up 36,000% with Amazon, about 3,300% with Intuit, and about 1,000%, if you will, with eBay. So I want to ask right now, and I'll start with you, Gary, are there names on your screen that you're looking at, hey, this thing may be a trade, but also this may be something I want to hold even longer?
Well, what I tend to do right now is I am looking for those companies that still have 30, 50, 100, 200, 300% earnings growth and big revenue growth. Why? If that continues, once the bear market is over, typically they will lead. And what I've done in the last couple weeks, I spent 100 hours going through bottoms of bear markets going back, 30 years. My favorite stock, and you brought up some great ones, out of the crash in '87, LA Gear went up like 15-fold in like 17 months because they were just starting to sell their sneakers and they went insane on their earnings and sales. So that's all I'm doing right now. I'm not so sure the market is ready just yet. I'm seeing a few names peaking out versus the market right now, but I'm still patient here. I'm still all in cash. When the market turns, I think I'll be ready because when the market does turn, I'll be working 24 hours a day finding those names. And you won't be able to miss them because they'll show up on the new yearly high list before anything else, and they'll be off to the races.
I love that because a lot of people feel like when they hit that new 52-week high list that they've already missed a move. If you're the right kind of investor, it's only the beginning. Michelle, what are you looking at?
Well, I have a little bit of a different take because if you're looking at the dot-com bubble or what Gary just referred to, which was during the S&L crash, those were saved by a very accommodative Fed. And we know now that the Fed doesn't have any intention, even though people are hopeful, of being accommodative because inflation, even though we've taken sort of this dislocation counter trend within the trend, isn't gone. So I'm still looking over the next year or so, really looking at not only companies that could survive, forget about recession, even a stagflation environment. That's why I think biotechnology is doing so well. Some of the consumer staples could come back. But I'm still very focused on commodities and also something that's going counter to what we're doing right now, which is a lot of the China stocks. So that's my focus immediately. Okay. Sure, we get through this. I agree with Gary. Then it'll be a fun time to go shopping. So
in the meantime, though, with worries of recession starting to surge, we've seen the price of oil just absolutely implode. And I don't know if these are the same investors, but as that's imploding, the ARK fund is racing much, much higher. In fact, yesterday, there was a 13% differential, the gain in ARK and the loss in the XLE. That's an all-time record. Michelle, I know you were actually in there nibbling in the ARK fund yesterday. You were a buyer?
I did buy yesterday, or what I kind of like to say now is I'm kind of hanging out with Kathy, but whether or not we're BFFs remain to be seen, because I definitely want to get out if it can't hold the 50-day moving average, which it cleared yesterday. So yeah, we're being very nimble in everything, but ARK was a good place to start because of some of the stuff that she had was so beaten up.
Right.
And in disruptive tech, if I'm totally wrong about this and we're going into disinflation, then she would be a good place to be.
Of course, Gary, some are saying now oil looks very attractive. It's beaten up.
I have to tell you, I am stunned. The OIH is down 34%. That's oil services in three and a half weeks. I don't know if I'd be a buyer. I think we have a major top in place here, and without a doubt, it's going to bounce soon. You'll probably get a good counter trend rally, but I'm a big believer in the major trend, and I think they may have started a major trend on energy, and unfortunately, I think my biggest worry on the economy is coming to fruition, and I think oil and commodities are yelling and screaming, we're in recession right now, and fingers crossed it doesn't get real bad, but I worry about the powers that be that don't know what the heck they're doing and basically are following the market and are so way behind. I'm hoping they do less, stay away, let the markets do their bidding, and I think we'll be better off.
You know, what's really interesting is just how quickly some of these things move. Everything is high beta these days. There's no such thing as low beta. Everything. I want to ask you about the big debate on Wall Street. It's really not a debate. It feels like everyone's on the same side and saying earnings estimates are simply too high. And even though they're starting to ease a little bit, there's a major disconnect between the trajectories of the S&P and earnings. In fact, our friend Lance Roberts has a good illustration here. So we've got the S&P. Wall Street expects it to keep going up, and yet you've got earnings which are going down. Some people believe this should be even a lot lower. How do you, Michelle, make the adjustment? Are there names that you believe these estimates are going to come down, that means the market comes down, or is there something that might be priced in the right way already?
Well, I think that's going to be an incredible discovery as we go through it. But what I'm excited about is some of the names you mentioned just at the top of the show, looking at Microsoft, which if it has earnings that are going to be meager compared to what it's done over the last several years, and we get a good price down to, let's say, around $220 a share, that would be compelling. Apple at around $100 a share would be compelling. So I'm kind of looking at the silver lining on this. If the PE ratios are still high relative to interest rates and potential recession, there's where your buy opportunity can wind up emerging. You
know, Gary, speaking of silver linings, for me, I just wonder about this debate a little bit because it feels like stocks are going to go where they're supposed to go or where they want to go. And Wall Street is always wrong. They always underestimate earnings. And I got a feeling by the time it's all said and done, we're going to be set up for some pretty big beats.
Well, let me give you the positive. There's been a good reason to lower earnings estimates and guidance. Just when Target came out with what they said and then had a lower 2 weeks later, Micron just came out with pitiful guidance going forward, really affecting the semis and the equipment makers. So yeah, there's a rhyme and a reason for that. But now, if commodity prices stay down, especially if energy prices can stay down here, I got a feeling that guidance doesn't have to get so bad. Just remember, it is a huge cost to the economy, oil prices, and we just dropped from 130. I think we're down at 100 right now or somewhere around there. That is a big expense cut for everybody through the food chain. So maybe it's not going to be bad as expected, and we'll know real soon in 2 to 3 weeks when everybody starts reporting, and we'll get a much better idea because they will start including this drop in commodity prices. That's the positive I'm looking at, but we're not there just yet.
Yeah, and the wage price spiral, I looked at the JOLTS report, those quits. Some of the numbers have come down a lot since March. Maybe that whole thing is starting to cool off as well. Gary, Michelle, great stuff. Thank you both very much. Always appreciate your guidance.